Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, the other big news, company news of the day, had to do with Tesla. So apparently Tesla's annual EV sales dropped for the first time in over a decade, with about 1.79 million vehicles sold in 2024. Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst, joins us. So the comparison of, hey, this is the first time it dropped in over a decade sounds bad. Can you just walk us through the intricacies behind this number?
Yeah, if you look at the fourth quarter, it's actually up slightly by 2%, but they've done a lot throughout the quarter to drive that number, mainly on incentives. So we're likely to see that to continue. But if you look out into 2025, we expect the company to actually give rosier guidance. They do have new vehicles coming out, the refresh of the Model Y, the popular Model Y, and then there's a new affordable vehicle being launched in the first half. That should drive sales in 2025.
So how important are incentives these days, Steve, for the average EV buyer?
It is very important. It's not just on EV. We're seeing that throughout the auto industry, including gasoline cars. Affordability continues to be an issue. If you look at delinquency rates on loans, they're rising. So the automakers have to come in and actually support demand. So we'll probably see that in 2025. But there's reports out there that we, including ourselves, we think that battery costs will continue to come down, and then we'll see probably a better an upturn, likely in 2026, not so much in this year.
When you mentioned that there'll be some product refreshes this year as well as an affordable Tesla, I've been hearing that for a while. What do we mean by affordable? And do we trust this timeline?
Yeah, so I think there's been a lot of questions out there in terms of how if Elon Musk will actually meet his own projection. I think that he will launch the affordable EV, and that's likely to be under 30,000, including that includes the 7,500 credit incentive by the federal government.
Oh, it includes it. So if that goes away, it no longer becomes affordable.
It still is. It's still one of the cheapest EVs out there. I think the new EVs that they're launching going forward will actually be much lower cost than the current Model 3 and Model Y. So there's still some room for them to cut prices and also probably help maintain the automotive gross margin around the 18 to 20%.
Steve, 2024 feels like a year where the evolution towards electric vehicles hit kind of a speed bump out there. A, is that in fact the case? And B, how do you think about the industry's continued evolution to EVs over the 2025?
Yeah, I think 2025 EV sales will probably be growing at a single digit, and incentives still going to be a bigger part of the story. But I think long term, beyond 2025, that means 2026 and beyond, I think EV sales will recover. Battery costs will continue to come down. More automakers, not just Tesla, GM and Stellantis are launching newer and cheaper EVs. That's going to resonate with the mass market. A lot of the early adopters have bought EVs, and I think the next leg up is really to get the general population to buy EVs and make it more affordable for them.
I guess I just wonder, without the tax credit, if that goes away. I appreciate that Tesla's still the cheapest one out there, but that's not going to be, there's no way Paul's buying a $38,000 Tesla, right? That's not happening. So what has to happen for that price to get even lower? And I know that it's a chicken and an egg thing, right? Because you need the demand in order to trigger the production, which then releases lower prices. But that's just not materializing, particularly without that tax credit.
Right. I think we talked about battery costs as being one of them. The other thing is really the charging infrastructure. I don't think the charging infrastructure has been expanded to a point where it's convenient for a lot of for owners or potential owners of EVs, but there's a lot of money being poured into it. There's one company called EVgo. They just got a huge loan from the federal government to expand. We got a lot of automakers, major ones, GM, Ford, and Hyundai, and the likes are actually joining forces together, pulling capital together to expand the infrastructure. So that's why, I think, beyond 2026, beyond 2025, we're going to see improved uptick on EV demand because of not only cheaper EVs, but an expanded charging infrastructure.
Steve, of the auto companies you own, what's the best positioned here, do you think, for what's going to be a bumpy several years, arguably, as this transition continues?
Yeah, I still, if I look at the company, I still prefer Tesla in terms of their fundamentals. They're still the lowest cost producers. The next one is probably GM and Hyundai. They have the best offering at the moment, and they continue to launch more affordable EVs. On the other end of the spectrum, Ford is actually retrenching. They're more focused on commercial EV business rather than the consumer EV business. So commercial EVs, there's demand, but obviously the market is not as big as the consumers.
All right. Thanks so much. We appreciate that, Steve. Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst, joining us on those Tesla delivery numbers.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we started a new year, green on the screen. The question is, do you stick with what got you here? Kind of the Mag 7, some of the big tech themes that have worked for equity investors so well over the last couple of years, or do you try to branch out and find some value in other places? Let's check in with our next guest on that issue. Kathy Entwistle, Managing Director, Morgan Stanley Private Wealth Management, joining us via Zoom. So, Kathy, what are you telling your clients this year? I mean, from an equity perspective, the markets really delivered outstanding returns over the last 2 years. But again, a lot of that was skewed by, a handful of names here. What do you do this year?
Hey, thanks for having me on today. Happy New Year. There's a lot to talk about and a lot to do for clients first day of the year. And with the Mag 7 really outperforming, we are telling our clients to consider reducing a lot of those positions with tax harvesting and thinking thoughtfully. A lot of clients are starting the year off, obviously, with a zero tax sum gain, and it's a good time to start reducing those positions and looking at other areas, because there will be other areas that will become more robust and better opportunities for clients going forward. So it's just about diversification.
In some ways, Kathy, though, this exact conversation could have taken place today at this exact same time 1 year ago, and it still wouldn't have necessarily worked out because you still had the big guys getting the big gains.
Absolutely, Alex. When I speak with my clients, I ask them, how are you going to feel at the end of the year if these positions are much higher? And then how are you going to feel if they're much lower? And which one feels worse? And if you think that if they go down tremendously and that's going to feel worse for you, that probably means you're taking too much risk for your, for your own risk tolerance and portfolio. And by reducing some of that risk and putting those assets in other areas of your portfolio, you're actually giving yourself a sleep at night formula and still having the opportunity to grow your portfolio.
Is 60-40, is that still a reasonable portfolio construction, 60% equities, 40% bonds, or alternatives now something?
It definitely has changed over the years. So 60-40, and it used to also be like 60% of equities, or the equity percentage should be what your age is. And that has also changed over the years. So now when we're looking at clients' portfolios, we're looking at a couple of different things. The first thing is, do they have enough money today in order to, reach all of the goals, like living comfortably, doing the things that they want to do, making an impact in the world, whatever it may be. We want to make sure they have enough money. So the first thing is protecting the wealth that the client has built and being sure that we can create the cash flow and the income for them. And then secondly, being able to grow it enough to keep up with inflation and also take advantage of growth opportunities in the market. So if a client has enough money to do a 50% equity portfolio or a 55% equity portfolio, we'll do that too. We are mixing in other areas of the markets, though, other than just cash, equities, and stocks in order to achieve some of the target returns that we're looking for. And that includes alternative investments.
What does alternative investments mean to you guys?
Well, to me, it means just like a non-correlated asset class. Earlier in the program, I think I heard conversations about hedge funds and hedge funds performing. So we do want to have, where it's appropriate, some of those asset classes in our clients' portfolio. So it could be hedge funds, it could be private equity, credit. You know, the whole banking system has this shadow banking system behind it now with private equity firms and coming in and providing credit to borrowers. And we are also providing the opportunity for clients to invest there as well. Again, it depends on the client and their risk tolerance and the appropriateness for that type of investment, but it can make a big difference in terms of not doing exactly what the market does, non-correlated asset class, and also providing some nice income returns, especially for those who are looking from, you know, they're in the allocation phase and now they're going into like the disbursement phase. They're getting ready to retire and they want to make sure they have enough money to live on and not run out.
Kathy, how about in the fixed income space? How much credit risk are you suggesting clients take these days? I mean, you can sit in a 2-year treasury and get 4.25%. Do you need to do much more than that?
Yeah, what you want to think about is the way the rates are changing right now, as we're seeing, is shorter rates are starting to come down and longer rates are staying higher. So we're trying to move some of our clients that have cash or short-term cash-like investments like 2-year treasuries into longer investments so that they can lock in those higher rates for longer. And I think that's a very simple and easy move to make right now for clients. So that's what we're trying to do.
All right, Kathy, thanks a lot. Really appreciate it. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management. Appreciate that really very much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's talk about some fun stuff here, some digital media, streaming, all that kind of stuff. Where is this business going to be taking us in 2025? The best person to chat with that is Mark Douglas, President and CEO of MNTN. Hey, Mark, I want to start with sports. We had a time as recently as, I don't know, a year and a half ago, when Netflix says we're never getting into sports. Well, that's changing, and it's changing in a big way. How do you think this last bastion of broadcast and cable network television in terms of audience attraction, live sports, how do you think that's going to migrate this year to streaming?
Well, I think you're seeing a few things happening at the same time. What you just mentioned, which is Netflix getting into sports. Also, ESPN is coming like fully to streaming. So I think the advertisers really they still are addicted to kind of like big audiences watching at the same time so they can create big moments. And so these networks, they want to accommodate that, but they're going to start accommodating that on streaming in 2025. It's already happening, but now you hear from Disney, you hear from Netflix, they're really going all in on it. I think ESPN on streaming, really going full in on streaming is a big deal.
Will the ad revenue for that live streaming of sports follow?
I think it will. I think the Netflix in particular is a big advantage because so many people go to Netflix as their first source, so they can turn something that might not have been that big into a big moment. They did that with the Tyson-Jake Paul fight. I think they're going to do that with WWE on Monday, where people who normally wouldn't watch WWE are going to turn on the TV, and that's what they see, and they're going to, click and watch. And so they're able to kind of amplify these sports events. But Disney with ABC and all their other, and especially ESPN, also has an ability to deliver a big audience. I think they'll do the same.
You were bullish, you were really early on the Netflix story, Mark. Are you still as bullish about them? Because one could argue it's a whole new competitive landscape here these days.
Yeah, I think where you go first, in some sense, the modern day TV guide, is a really, really big deal. And as long as Netflix owns that spot, I think there's data to show that well more than 50% of people, when they turn on the TV, the first app, because now you like start an app rather than change a channel, the first app they go to is Netflix. As long as you own that spot, you will own, kind of be the leader in streaming. But it requires a big investment in content. And people go there first because that's the first place they think there's going to be new content. So Netflix is going to have to keep feeding that machine. And they're doing it now, and they're doing it profitably. So, all of that combined, I think, keeps them in the lead until they make a strategic error, essentially, and maybe, get cheap about how much they're willing to spend on content. People abandon them.
So you guys, I found the one movie that's not on streaming.
Really?
Yes, I tried to bring it up yesterday to show my daughter, and it was nowhere. You couldn't even buy it on Apple TV.
Okay, what was
Nuns on the Run, 1990 British comedy with Eric Idle and Robbie Coltrane. Could not find it. It was very upsetting. Just
Interesting.
Putting this out there.
That's what you were searching for. Yes.
Well, we went on a whole 80s movie thing, which then brought us some of the 90s movies. So we did Clue, and then Clue got her into Back to the Future, and then, Robbie Coltrane was Hagrid and Harry Potter. It's all derivative plays at the moment. Anyway, apropos of absolutely nothing, I just thought it was amazing that I found the one movie that wasn't on streaming. Mark, when it comes to the next step then, are we going to see bundles? Like you said, it's Netflix's basically race to lose at the end of the day. So do the other guys start bundles?
Yeah, I mean, consolidate bundles in the form of acquisitions, I think. So there's some loose bundles now that don't involve acquisitions, but I mean, what's happening in 2025 is every network is all in on streaming. I mean, when I talk to executives at all these networks, this is pretty regularly. Linear doesn't even come out of their mouth anymore. That's a legacy business. The viewers are still there, so they still have to migrate them, but they only want to talk about streaming. And the big winners, I've said this many times, are the ones where I can name them and you can tell me why you go there and watch them. Yep. And so those winners are going to start consolidating to buy content, and it's already underway. And that's kind of what's going to happen. That bundles in the form of, let's just start buying content and buying these brands, which are going to disappear like old, car companies that you never hear about anymore. Something similar to that.
So, are the economics, are they as good in streaming, Mark? Do we know that? I mean, it seems like they're pretty good for Netflix.
They're good for Netflix, and I think starting to get good for Disney. And, it's when do you reach a critical mass of subscribers that is more than your cost of acquisition for the consumers and the cost of the content. And Netflix is clearly at that point. I think Disney is, if not, I think Disney Plus is now profitable. I hope they don't underinvest in content to maintain that profitability. And a few others are going to follow. I think the business is going to become very, very profitable. And it's going to go back to being a growth business. That's been the story of linear, is it grows at 1% a year, and streaming has obviously grown a lot faster. So hopefully the whole industry is going to grow a lot faster.
If everyone's talking about streaming, are the ad pricing that a streamer can get as good as linear? And then if not, when does that ship turn?
Yeah, it is as good. The ad load is not quite as high. And so consumers are probably happy about that. They see fewer ads, but the ad load will probably catch up. And so the pricing is about the same, meaning how much money can you make per consumer is about the same. One thing also, just switching back gears to, kind of the previous topic, the interesting thing about Netflix is they're profitable while they're bringing 1 out of every 2 subscribers is paying the lowest possible price with ad supported. And they're not selling many ads, right? They're still relatively small in the ad game. And so it bodes well for how profitable this company is going to become. I think it's $5.99 price point is the cheapest price point to join Netflix, and they remain profitable, not actually expanding profits at at that price point, and the media dollars are going to show up and make this company incredibly profitable. So that's back to the question about, is the industry going to grow? Is the profitability going to be there? Yeah, it's going to be there pretty big, and particularly pretty large for Netflix.
Is there a sense, Mark, how many streamers can be economically supported in this marketplace?
You mean in terms? There's I wouldn't call it unlimited demand for TV advertising, but there's a lot of demand. The pricing has been coming down a bit because of the competition you had in like Netflix started to really come on board, Disney Plus, Amazon Prime. Now every subscriber receives ads. There's not even a way to opt out. And so all of that new inventory is definitely bringing prices down, triggering a little bit of a price war. But I think that'll shake out when you combine that with the acquisition spree that's probably going to happen over the next few years. I think pricing will temporarily dip, then start to go back up. And the main thing is you have a lot of new advertisers coming in the market, a lot smaller, younger, mid-sized companies, smaller companies, and they're bringing new revenue that will drive up revenue for the whole industry.
Mark, are we ever going to see the streamers get really into news, talking about live? I know that some of them have their own streaming news part, right? Like CBS Now, et cetera. How do you think that part evolves?
I think probably not. And the reason is because, like no one really, I think, fully understood in the recent years that like social media is a big competitor in news. So to get the kind of news that people are getting literally right now, listening to you, I don't see, I think that's going to remain relatively independent. I don't see like Netflix and Disney getting into that. And I've honestly never hear from any of these companies about news. They only want to talk about sports and entertainment.
Yeah. Interesting. Mark, so what happens to some of those linear networks that we all grew up with? Did the media companies just let them die a slow, natural death?
Yeah, that's a really tough question to answer. Because I wonder that myself. I can't say I have a response. I just don't see like a brand like CNN just disappearing. Right. It's just too strong a brand, but it's going to need to go through some evolution. Clearly, people aren't showing up for that. The other thing they're competing with, I mentioned social media, is podcasts. There are numerous podcasts that have more viewers per day than like CNN. And so, and by a lot, not a little, and through multiple outlets, like podcasting and YouTube and things like that. So I think that's still evolving, but I don't see the, brand like CNN just like disappearing. But it's going to have to evolve.
All right. Hey, Mark, we really appreciate it. Thanks for hanging on with us. Mark Douglas joining us, President and CEO of Mountain.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.